My views on finance and investing are very controversial. They clash with the common narrative. The idea is that we should buy stocks whenever they dip because stocks is productive capital. Stocks tend to make money over time. We might also buy gold because gold appreciates over time. It might not make as much return as stocks. I disagree with that as well. We might have to buy a house because houses are great investments. They also go up over time. All of those things are right, but also wrong. Because really, a house, for example, is not an investment. And why do all of those things go up all the time? It's not that those things become more valuable. A bar of gold 100 years ago is not more valuable than a bar of gold today. The reason why those things go up is all just monetary debasement. And too many people are too lazy to quantify this, to actually have a look at how much of an impact does monetary debasement have. Once we understand how much money devalues, we suddenly get an idea how to potentially beat the system, how to potentially make more money than most. Because here is what most people think. Just buy the S&P 500, for example. This is an S&P 500 long-term chart. This vertical line, by the way, here is when Bitcoin got launched. That was at the height of the global financial crisis. And because the S&P 500 goes up all the time, just buy those dips, right? It's great to long-term make money. Now, this is a linear scale. On a logarithmic scale, the thing looks like this. This here was the Great Depression. Here was the dot-com bubble burst. Over here was the global financial crisis. And again, this is where Bitcoin was launched. But really, this line going up is no expression whatsoever for stocks being a good investment at all. We do not gain any purchasing power by getting into stocks. The real reason why this line is going up long term is this guy over here. It's the Fed chairman. It's the devaluation of money. It's the expansion of the money supply. This line here is also going up, right? This is USM2. It's the money supply. And when you've got the same amount of stuff but more money, then of course prices go up. But the question is, how much of an impact does this have? Most people think that the monetary devaluation is just the official inflation rate. But how does this actually make sense, right? The official inflation rate tends to be at around 3% very long term. But the monetary base expands much faster than that. Here's the official inflation rate in the US. And this dotted line here, that's the average across all of those years. So officially, we only have 3.3% inflation per annum. It fluctuates up and down, but on average, it's 3.3%. And so we might now talk about the reason why this number is getting artificially depressed. There's all kinds of conflicts of interest. I'm not diving into those conspiracy theories now. But the fact is, this inflation rate is very different to this expansion rate of the monetary base. This line here on a logarithmic scale goes up almost without any fluctuation whatsoever. Yes, there are times where it expands a bit faster and a bit slower, but this growth here is 6.8% per annum. Not 3.3, but 6.8. Now, why does that matter now? It's just 3 percentage points. The reason is 3 percentage points compounds over time massively, and 6.8% as a hurdle rate gives us a better idea whether or not something really appreciates over time. Because imagine the monetary base was completely static, right? Like it's with Bitcoin. Bitcoin does have its mining, but Bitcoin also gets lost. So the liquid Bitcoin is somewhat static. Everything, all the products should actually long-term get cheaper versus a steady money supply because we become more effective, right? We are more efficient at building our things. Technology progresses over time. So when things don't get cheaper over time, that's just because the monetary base is expanding. So when the monetary base is expanding by 6.8% and we still measure prices going up by 3.3%. That means that those additional 3% that are unreported, that's how much more productive we actually became over 1 year. This impressive appreciation here of the S&P 500, and we can draw similar lines for the housing market or for gold. This kind of line is only generated because of monetary expansion. Let me show you something. What we've got over here is the S&P 500 divided by the US money supply. So how much do stocks outperform the monetary expansion? Or in other words, how much productivity is there in buying a stock? If there is so much active capital and all those working people create so much additional value, then of course that additional value should get reflected in an outperformance over the debasement of the currency. But do we really see that? This chart starts in 1959, and since then the S&P 500 outperformed monetary expansion only by 50%. So that's over the span of 65 years, less than 1% every single year, even if you compound. Have a look at the S&P 500 relative to gold. Now this starts in 1885, and yes, this might long-term go up, but it also might not, because we have seen incredible crashes versus gold in the past. This is a drop of 94%. Now why am I getting so excited about this? Because a 94% drop isn't nothing, right? It's pretty much all the capital getting destroyed versus the real money, right? Versus gold. People always say buy the dip, stocks go up long term, and nominally that's true. But relative to purchasing power, it can take a very long time. This year, it's again the S&P 500 relative to monetary supply, is 37 years until you just get your purchasing power back. This year is also 30 years. And again, the drop was massive. And do we really long term outperform with the S&P 500? Is gold a long term underperformer? Who knows what kind of crashes we can see in the future, right? We see that currently the S&P 500 is high relative to gold. So that's this chart. It's also high relative to the monetary base. From the peak here in the dot-com bubble versus the trough at the end of the global financial crisis, we saw a drop of 73%. So on both of those measures, stocks are very expensive. There's also another measure. This is the Shiller PE ratio. So this looks at the price to earnings ratio over the last 7 years. So we also average this out a little bit. What is the price to earnings ratio? It looks at the earnings of a company versus its current price. So whenever we buy a company, whenever we buy stock, we're essentially buying the future earnings of the company. We invest money today in order to get dividends in the future. Dividends is whatever the company is making. And so really the US dollar price of a stock doesn't matter. The only price that matters is how expensive is the stock relative to the future earnings that we are actually buying. And this ratio fluctuates quite a bit as well. It might appreciate long term because those peaks go higher and higher. The bottoms don't necessarily go that much higher over the centuries, but the extreme level in 1929 was definitely lower than what we saw during .com. This could be explained again by many factors. Maybe there's simply just more adoption of investing into stocks, right? Maybe just a higher fraction of the population now has stocks. Or maybe US stocks are now in much more demand globally than they were 100 years ago. So there is a case to be made that maybe this chart should go up long term. But still, we are currently at 38 of an average PE ratio in the S&P 500. And seeing something like 20 wouldn't be surprising whatsoever, right? So a 50% drop relative to earnings. Imagine gold just stays where it is and this would drop by 50%. Then we would also go somewhere to an average level of the S&P 500 relative to gold. Let's look at the S&P 500 relative to the money supply. A 50% drop, again, would bring us somewhere in the middle. And so all of those charts align, right? It all makes sense. Stocks are historically incredibly expensive. And the question really is, does it make sense to always buy the dip? Yes, you will have more US dollars because the money will get devalued during a crash of the S&P 500. But would it make more sense to rather buy gold? Because gold will also go up with monetary debasement, arguably even more than stocks. Just imagine you would ride this wave and you would have much more stocks when we are low here on this gold to S&P 500 ratio, and you'd have much more gold when we are high on the ratio. So right now, according to the strategy, we would own much more gold than we would own stocks. This is a very controversial take. Most people think that stocks return so much more than gold long term, but according to this chart, it's not that clear, right? We've got all of that volatility. And if we ride the waves somewhat and we have more gold at the top and we've got more stocks at the bottom, then the potential reward is huge. This here is a rally of 3,000%. Had you bought stocks at the beginning of the 1980s and you sold it at the end of the dot-com bubble, you would have made that much more outperformance versus gold. And again, if you're not too heavy into stocks, you would have been spared of this massive 90+% crash. All these kind of charts put things into perspective, right? Are stocks really that risk-free long term? Because the fundamental question with investing is not, is this investment better than just holding fiat currency, than just storing cash under the mattress? The question is always, do we actually get more purchasing power over time? Hoarding a lot of cash under the mattress is no option, right? We already can throw this out the window. We only have cash for our day-to-day expenses. But when it comes to asset allocation, do we really want to hold a lot of stock now? Do we really want to hold a lot of property now? And is the S&P 500 really that safe? Does it make sense to buy every single dip? Given that when we adjust for monetary debasement, it can take decades, multiple decades, to get the purchasing power back. And then as an extension, is Bitcoin really that risky when the S&P 500 relative to gold can crash more than 90%? Bitcoin tends to crash similarly, right? 70, 80%, a bit less than 90% in the recent past. But the big advantage of Bitcoin is that it does not take 20 or 30 years to get the purchasing power back. Bitcoin is more volatile, but Bitcoin also recovers much faster. To get out of this bear market, again, one has to wait 30 years. But check out this long-term chart of Bitcoin, right? This is Bitcoin relative to the monetary debasement. So it's not the US dollar chart. How long do we here have to wait if we buy at the wrong time? The answer is 3 to 4 years. It does not take 30 years. It takes 3 to 4 years. So really, what is more risky? Is Bitcoin that risky of a long-term investment relative to stocks? I have my doubt, and this is the controversial take, right? Of course, among Bitcoin maximalists, everybody knows Bitcoin is the best, but in general, I do think that people underestimate how risky stocks really are and how expensive they currently are. Because everybody that made money in stocks in our previous generation, right? Let's say the people that are currently 60, 70 years old, they all made very nice returns with stocks. But I'd make the argument that that's recency bias. Because over the last 40 years, stocks did on average outperform monetary debasement. But ask your parents what their parents thought about the stock market, if they were so happy. Or if they rather preferred to own the farm, if they rather preferred to own gold, and if they thought the stock market is rather a risky endeavor. And so what do I want to say showing all of those charts? What I want to say is that please forget about US dollar changes. Always think about relative performance to the monetary expansion. Are you expecting an outperformance above or below 6.8%? If it's below 6.8% per annum, then you need to have another reason why you buy that thing. If you buy the house with the expectation that it appreciates only by 6%, which is the historical average, then by all means do this if you want to do this just for consumption, right? Because you like to live in that house. Or if you're considering to finance that house, then go ahead if the financing rate is less than 6.8% per annum, right? Because if you get financing just for 3% per annum, then your debt devalues every single year. It becomes easier and easier to pay back that debt. This is how people actually make money with property. It's all just by the devaluation of debt. So the house appreciates by 6%, still less than monetary expansion, but the debt depreciates even faster compared to what needs to be paid to serve the debt. So there are many, many implications from this line of thinking, right? For example, when you earn money, when you sell your time, and you don't appreciate that income by 6.8% per annum, you're actually falling behind. It will get harder and harder for you to buy that house, to pay for that vacation, etc. The only thing that will be easier to pay if you get less than 6.8% per annum increase is the consumables that get cheaper long-term anyways because of technological progress. I'm not going to make elaborate promotion for my premium membership this time, but feel free to check it out. This is how I outperform the market. It's down below. It's thebitcointrader.com. If it's the very first time over here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.